What's up, guys?
It's Rowan
and Terry
from Artismart TV, bringing you another episode of the HSC Economics Review. Now, in this episode, we're going to be unpacking the state of the Australian economy for 2022. So much is happening right now around the world, whether or not it's a war in the Ukraine, Omicron, and what we want to look at, particularly with a federal election on the horizon, is what the state of Australia's economy is right now and perhaps what it's going to look like over the course of this year. So let's dive in and kick things off. And I think that one of the best places to begin, Terry, is with economic growth overall. What's our economic growth look like, particularly with Omicron playing a bit of a role?
So I think the important thing first is to recognize that we're not going to have the absolute most recent stuff. So the best that we do have is just the September quarter from 2021 at the moment. And what we do have is that compared to the quarter before that, it was actually a 1.9% decrease. But when you compare that to the same period year on year, it's actually a 3.9% increase. So I think, Rowan, you do want to mention something about just the momentum kind of shifting and picking back up a little bit.
Yeah, so I think what's interesting about it is clearly that was a result of, both really for that quarter, September was really Delta still, right? We hadn't really seen Omicron as a wave coming through. That started occurring November, December, right? So the start of that quarter was particularly impacted by Delta, and then of course Omicron really hit. So it's no surprises that we saw a 1.9% decline. Now, the good news in that for that quarter is it was expected to be a 2.7% decline. So the Australian economy actually handled both the Delta and the Omicron wave and the associated shutdowns with it better than predicted, which I think is a real positive. Now, as Terry said, the sort of silver lining on all of this is last year, the sort of change on the same period was 3.9. So there was an overall positive in that respect in terms of economic growth that Australia managed to have in the 12-month period prior. What it means moving forward is going to, I think, be quite interesting, Terry. So that's obviously the last data point we have right now. We'll get another data point, after March, after this coming quarter. What do you think this quarter is going to look like?
Well, I think we are going to see a little bit of a small disappointment, but I think, as you were saying, like we do feel that it's been more positive than we might have expected, but I think we shouldn't be too optimistic
just yet. Yeah, exactly. Now, look, really quickly, the Reserve Bank of Australia, they're, again, sort of reserved but optimistic at the same time. They have predicted that the Omicron variant will slow growth in the March quarter, but they agreed that it's probably, as vaccination rates are so high, businesses and consumers are more, confident in dealing with the restraints that are imposed. Their expectation is that for each successive wave, particularly Omicron not being as severe, the impact on economic growth will be a lot less. And so they have predicted, from a growth perspective, that they're forecasting 4.25% over 2022 and 2% in 2023. So there's sort of a normalization that will start to occur.
And I think that also just reflects the way that we are personally responding to these successive variants as well. Because if you think about, Delta versus Omicron, there's just in terms of the restrictions that were imposed, I think Omicron was definitely there was a lot less in place, and there is much more of an emphasis on just getting back to normal.
Yeah, without a doubt. Now, so economic growth, I think as a result, we can say, yes, Omicron's going to have a drag effect on growth, but overall we should expect to see positive growth in the 2022 year, somewhere around the 4% mark, give or take, right? Depending again on ongoing variants and our ability to respond. Now, perhaps the bigger issue that is arising is inflation. And that's not just an Australian context. I think that's quite global. Terry, do you want to dive in a little bit and share just some of the inflation figures and what might be driving some of these?
Yeah, so for the December quarter, just our year-on-year annual inflation rate was actually increasing to 3.5%. So for those of you who remember your RBA, target range of 2 to 3%, we've actually now gone over the top. So, a lot of our videos last year were actually talking about us being actually below, and now we're actually above. So it's something which we haven't really been able to get right lately. There's probably two main reasons for this. Okay, so the first one is just that there's been lots of issues with supply in the construction industry. And then secondly, and we will touch on this in another video very quickly, just about fuel prices, right? And obviously we know there's a lot going on in that regard too. So those are probably the two biggest drivers for me that are pushing inflation higher.
Without a doubt. Now, I think it's probably important to highlight just really quickly, inflation 3.5%, particularly, but it was really interesting. In the quarter itself, it rose. December quarter, it rose 1.3, right? But annualized, we saw a 3.5% increase. Now,
that's a big increase for one quarter.
That is a big increase, right? Exactly. And a lot of that, you're right, was very much, and I just want to highlight, like this was the 6th consecutive quarter fuel prices rose. They're the strongest annual rise since 1990, right? So we're sort of seeing definitely like record levels of fuel prices as a result of high global oil prices. And yes, the Ukraine-Russia conflict is going to exacerbate that even more. And yes, stay tuned for another video where we'll unpack those sort of impacts. Now, one of the things I wanted to highlight, Terry, because I found this interesting, is if you look at the weighted average of what's contributing to CPI, right? Definitely transport is a clear driver, right? Housing has also played a bit of a role there. But what's been interesting is, this distinction between non-discretionary and discretionary inflation is now starting to emerge, right? And so just as a quick explanation, it's not something that I think really gets talked about in the HSC Economics course, but I think it's a good sort of extra level of analysis that you might bring when you're analysing the impact of inflation on families, particularly, and on essentially real income. And that is that non-discretionary inflation essentially refers to inflation on the price of goods and services where families are unable to make different purchase decisions. So, that's more expensive, I'll stop spending. That's a discretionary expenditure item. So for example, that might be maybe some entertainment, right? You might decide, entertainment's got really expensive right now, we'll dial back. Or on the other hand, food, fuel, housing, and health, right? The big four, they're not non-discretionary in that you basically are going to spend money on them. It's almost like autonomous consumption, right? You need to spend it from a point of living. And the challenge is that ultimately the inflation at the moment for non-discretionary is twice as high as the inflation rate for discretionary. And that's sort of problematic because if you look at it, right, the CPI on average is 3.5%, as we've sort of unpacked. Discretionary inflation, so inflation on goods and services that we might just choose to not spend money on, that's 1.9%, right? The problem is, and this is why I think the CPI can sometimes, hide the impact on sort of families' pockets in terms of the actual increase of expenses, is that non-discretionary inflation is 4.5%.
I think that's a really, really fantastic point, Rowan. Like, I think the thing with things like CPI, where they're an index, they are essentially taking this whole basket of your average household, but we all know that there is really no average household, right? It's actually just, looking at all the whole population and trying to create that. But in reality, it's not really a thing. And my thing is, I think we've been talking a lot about just the supply side, but I think we should also maybe just, for some of the viewers, they might be thinking, well, hang on, isn't this quite normal that we're getting more inflation just because the economy has recovered from the demand side as well? So I think, we do recognize that that's definitely a part of it as well. But I think right now, what's more interesting, what would be more, I think, impactful to unpack is just those supply sides with those increases.
Without a doubt, I agree. And I think that's probably, just for a moment then, a good point to, I think, really probably just jump over and take a look at some of the business conditions from a supply side perspective. Because you're right, like ultimately, housing, fuel. Well, the reason, fuel prices are going up, one is because there was higher demand globally from a global recovery. But certainly, Ukraine-Russia conflict is already created sky-high impacts on, the price of oil. So we're definitely going to see ongoing supply issues and inflationary pressure there. I think in terms of the rest of the economy, what's quite interesting is that 36% of small businesses have been more likely to be greatly impacted by supply chain disruptions, right? 47%, so almost 1 in 2 businesses across Australia have said they are experiencing supply chain disruptions. So as we said, 36% was to a greater extent, right? They were greatly impacted, where 61% were affected to a small effect. So in other words, you've got 1 in 2 businesses that are saying supply chain, we're not getting stuff on time, it's taking longer to get here, or unable to source it, which just creates an auction effect. There's less goods, Demand's recovering, so people are going to be wanting to spend more to get access to these. And then out of those 1 in 2, 1 in 3 of those are experiencing severe supply chain disruptions. So it's pretty significant, I think, in that respect, in terms of just the degree to which it's impacting business and therefore impacting prices that the economy is experiencing right now. Do you have anything you wanted to add to that, Terry?
No, I think that's actually quite a nice segue just to get into wages, because I think another key element of that unavailability and shortage of issues and supply chain disruption is just the disruption to the labour force, right? Yeah. Which is, at the end of the day, one of the key resources for a business. And so we're also seeing this issue with just businesses not being able to find appropriate staff.
Yeah, and there's some really interesting data on that, right? Which is, I think, quite fascinating. Yeah. So 18%, this is January figures, 18% of employing businesses did not have enough employees based on current operations. Now, that's a little bit down on June 2021, 19%, but it's certainly up on March, which was 12%, when we were relatively open at that point, right? With sort of pre-major Delta sort of variants coming through. And a lot of that is a mixture of, issues with, of course, COVID, right? In terms of staffing, inability to find suitable staff, uncertainty due to COVID are both in the 60% in driving that. Jumping back, right, I think what we want to now think about is, okay, clearly their businesses are struggling, in terms of if staff are off sick, and also because demand's grown really quickly, again, they're trying to find staff to step in. What's that doing for both employment and wages?
Yeah, so I think if you just think back to your textbook theory, that when you do get that increase in demand for labour, but also then that supply shock, you're actually going to see a bit of a double whammy effect in terms of just driving upward prices in the labour market, aka wages. So we actually have seen some quite good when you just look at it on the surface, okay? But I'll break down why it's not so good when we think about it more clearly. But private sector wage growth has rose 2.4% through the year. And it's actually maintained that for 2 consecutive quarters, just to show that it wasn't really just a flash in the pan. It's actually keep continuing. Public sector, as we could probably expect, not as strong. Spoken from a public sector employee. It grew, however, it did grow 2.1%, and it's still been increasing since it hit that low of 1.3% in June of 2021. Now, what I was going to say earlier, though, is you've got to always remember, though, when you talk about wages, you should think about what is inflation doing at the moment. And if you have a look, what we said earlier with inflation, well, who's been paying attention? What did we say inflation was?
So we said inflation was 3.5%, right? And note that if you start looking at non-discretionary, it's even higher. So if it's 3.5% and we're saying that wage growth was, overall, 2.3% over the year, we have a problem, right, whereby real wages have gone backwards by 1.3%? Is that right? Yeah, I got to get my maths right here. 3.5 minus 2.3 is
1.2.
1.2, thank you. Yeah, good, right? There we go. Don't trust my maths. We've got to double check it.
This is not a maths review, so it's all good.
So in other words, we've seen an erosion in real wages. What are some of the consequences of that, Terry?
Well, I think it's just really just reducing that, for first of all, the purchasing power for just regular households. And I think when you touch on the whole discretionary versus non-discretionary impact, I think it could also lead into discussions about just equality. Right, because I think at the end of the day, there are going to be families who are relying on that non-discretionary element. Most of their consumption will be non-discretionary, and if their wages are also not growing, it's actually going to hit them a little bit harder.
Yeah, that's right, definitely. Now, I think a couple of interesting things in this. One, again, just linking into topical news, we've obviously had, train strikes and as part
teacher strike. There was a teacher strike.
Yeah, teacher strike. Yeah. So we've also got, because the public sector actually has generally fallen behind private sector wage growth over the last couple of years. Part of that was in
nurses strike. Sorry.
Yeah. As a result of definitely. As a result of public sector wage price freezes, right, which were implemented as part of budgetary controls. Over the last couple of years, and so we are shaping up, particularly in 2022, for a lot of industrial action. Yeah. So it'll be interesting to see, and I think this goes to the next point I want to highlight. If we're looking at where this wage growth is coming from, okay, the drivers of the wage growth is not from really awards or enterprise agreements, which historically is maybe generally more where we would see some of the wage growth coming from? It's actually come from individual arrangements. So employees, employers negotiating individually. And I think that's really a result of just a tighter job market. We've got unemployment to sort of link in at 4.2%. That's incredibly low. Now, a big part of that is also combined with we've got less immigration that's happened. We've had people that have gone back to their sort of home country, so to speak, which has reduced in some sense the available pool of talent, certainly in skilled roles, which is why I think we're seeing individual agreement being the bigger driver in wage growth. Now, did you have anything?
Yeah, I just want to touch on. I think if you think about just what's going on in our American cousins, that they also had this whole Great Resignation period, and I think there was also a little bit of momentum here in Australia to kind of also emulate that as well. So I think when you do get that movement in between roles, there is an opportunity to negotiate and bargain for those higher wages.
Definitely,
which has definitely probably showed up.
Yeah, I agree. Now, one of the interesting things to highlight is, for a moment, right, wage growth looks good. Yes, it's not as great as it could be because of the inflationary data as we've looked at, so that wages, real purchasing power is going backwards still by 1.2%, to get the calculation correct. But what's interesting is that, the RBA does have a couple of comments on this, right? And the RBA sort of has highlighted, look, great, yes, wage growth has, sort of picked up, but ultimately they note that the wage growth is sort of at the levels it was before the pandemic. And Terry and I, we have a number of prior HSC Economics review episodes looking at the fact that, remember, that was the problem before the pandemic in our economic growth, that we had really about a decade of fairly subdued wage growth, which was one of the causing factors of low inflation and low consumption, consumer confidence, and pretty stagnant economic growth. And so it's just interesting to note that, yes, we've seen 2 quarters on a clip, particularly for the private sector, that have been going the right way. It does sort of suggest, that we've still got some way to go, particularly with monetary policy stance in very accommodative expansionary settings. If monetary policy is already suggesting, well, look, it's good, but it's sort of similar to what it was before, and we already knew we had a problem then. Diving into employment, what's been happening? We've sort of touched upon it already, Terry. But let's dig in a little bit more into the labour market.
Yeah, so I think it's just fascinating just to see this labour market. I've never seen anything like it, but we've got just unemployment at 4.2%, very, very low. We've got participation basically recovering back to pre-pandemic levels at 66.2%. The underemployment rate also fairly impressive. I think even before the pandemic, it was actually a little bit higher, around that 8% range. It's actually now at 6.7%. So just not we're not numbers people.
We say that after going through how many numbers today?
Too many numbers. So yeah, it's just really fascinating, because when you look at this, you think this is a really, really positive economy, but then that's just not reality. So is there any analysis you have of why that might be the case?
Yeah, so I think, I think ongoing unemployment being as low as it is, I think is in part also due, while participation's up, I think it's also just due to the fact that we have like a smaller labour force, ultimately, right? Due to lack of immigration. Like, Australia has traditionally relied very heavily, right, on skilled labour and skilled migration. So I think there's an element of that. I think it's interesting looking at this because certainly the recovery of demand has been really driving that strong ongoing employment growth. Now, Omicron did impact it a little bit. And I agree, usually when you see such a low unemployment rate, you would expect to see a higher underemployment rate. Now, I think underemployment did touch up a tiny bit, in this sort of January data. It went from, I think, 6.6 to 6.7. So it only marginally went up. But I think the reason for that is just ultimately, it's not surprising, as the economy grows, you generally see more people start actively looking for work. They either become a slight increase in unemployment, which we haven't seen because the demand for new jobs offset that. But generally it does mean that people might be picking up part-time roles, particularly because, remember, a lot of businesses still have high levels of uncertainty on the economy. And we'll look at business confidence shortly, but I think that feeds into businesses maybe going, oh, you know what, we'll start someone part-time, or we'll start them casual. And so I think in some sense that's why in January the underemployment rate ticked up a little bit. Now, I think the really positive in all of this, and this is one thing I have seen, which I think is really great, Terry, just to go back to your question earlier, is that youth unemployment rate decreased to 9%. and it's 2.6% lower than in March 2020. Now remember, March 2020 is pre-pandemic levels really, right? Because that's just when COVID really hit the scene. So we've known that across the decade of post-GFC, youth unemployment really took 10 years to recover. It was the most impacted by the GFC. And so to see us 2.6% below really what was at that point one of the lowest youth unemployment rates we'd seen for a decade, I think is fantastic news. And so what I would say is I think really the winner at the moment in the labour market is actually young people.
I don't feel it though. Yeah, but I do want to touch on that. I think it's quite a dramatic decrease when you think about it, and I think it's worth unpacking any possible reasons why. I think there was a bit of a fiscal push in terms of reskilling and training young people.
And funding for businesses to take on. Yeah. I mean, it wasn't super successful, at least from the government.
But it was there.
It was there, right?
Yeah. And I also just think, when you give young people 2 years where they're just not having a lot of opportunities just to get out there and have fun, eventually what they'll realize is I don't really have much to do except I will go home and I will study on my computer. And I think that's actually possibly one of the drivers here. I mean, I don't know. I haven't seen any kind of analysis that's been done on the youth unemployment at this stage.
I would say something I've observed, and I actually think this is probably the main driver, is that corporate has really, I think, struggled because, skilled labour, as we've talked about, has really, shrunk.
Evaporated.
Yeah, evaporated. And honestly, corporate often would rely on, a high level of skilled labour in a bunch of different industries. Now, the challenge is if you're not able to have people that are highly skilled from overseas that are coming and working in Australia, who do you need to go and hire, right? And so I've observed and seen increasingly, final year university students being offered full-time roles before they're finishing a year earlier than they would have typically, simply because companies, and particularly the corporate sector, don't have anywhere else to go, right? They're trying to look for people. Either they're needing to poach and it's expensive, right? So it's costing a lot of money on that side of the job market, or they're coming in. And I think a good example of this, maybe relevant particularly, not so much directly to you, but certainly to teachers, is I think this has happened with the teaching profession as well, in that, there's obviously a shortage. We've got, a need with COVID, teachers being unwell, and so you've seen final year pre-service teachers, right, being pulled in and being given, much earlier opportunities for full-time roles than they would have typically had prior, right? And so I think that's a big part of it. I think it's the constraints that are happening in the skilled market that is really forcing corporates to go down market, which is the opposite of what happened during the GFC, right? During the GFC, because there was a lot of supply in the skilled, right, the corporate market was being able to access skilled labour for cheaper, which is why youth unemployment really got hit hard for about a decade. So it's sort of an inverse, I think, that we're seeing at the moment.
Yeah. I just had one more point. I think also just because young people are, just growing up in such a digital age that they have some really, really great, skills, which, I'm not saying older people don't, but I think just that younger people just might have that little bit of edge if you are in a situation where you are needing to work from home. And so I think that's definitely also really, really helped them get a foot in the door.
Well, I mean, digital natives, right? Yeah. Working from home, it's all in the cloud. So I agree, definitely, that's going to be skills that are valued. Let's dive in and look at then, I guess, how all of this plays out on consumer confidence and business confidence, right? I mean, we've touched on both of them a little bit, but I think it's worth doing a little bit of a dive in here. What's been happening with consumer confidence, particularly given Omicron?
Yeah, it's not great, but I think we could have probably expected worse. I think that's just the theme that we're going with today. So we've got the often used the Westpac Melbourne Institute Index that we use of consumer sentiment. It fell by 1.3% in February from January, and I think we can very likely attribute that just to the Omicron variant that's really torn through. Yeah. But I think if we think about the cases for that, it also has started to really kind of peak.
Yeah, I agree. And I think if you look at it, right, it's actually better than it was in February 2020, right? So February 2020...
It's 2 years ago now.
Yeah, right. Which was, again, you were starting to hear the rumblings of some, global pandemic possibly. So I think it's important just to contextualize that. Like, yes, it's fallen, but it does really show that there is a resilience that's starting to emerge.
Yeah,
right?
I was going to say that, yeah.
Yeah. Awesome.
I think we basically, in 2020, it was like, to just set the scene, right? We were just we were just we were a different society. I think these past 2 years have really just matured us and really just kind of set a different set of expectations. Now, I just want to very quickly diverge on this, but economics at the end of the day isn't just about numbers. There's also a very human, emotional element to it, and I think we definitely see that in these past 2 years. We've really hardened up. We've matured, if you will.
Yeah. Now, a couple of little things I want to highlight here, which I found interesting. Even though the overall number in terms of our consumer sentiment didn't shift all that much, and it was well above even 2020, there are a couple that were quite interesting. Family finances versus a year ago fell 9%, which isn't great. Expectations, interestingly, about unemployment, and so increasing concerns about unemployment also grew. So there are some areas that I think were interesting, but in the positive, despite that, people's belief in economic conditions improving over the next 12 months improved, right? And economic conditions over the next 5 years improved. So what it shows, I think, is that people are looking at the future a lot more positively, which is great. And they are sort of still, they're feeling the consequences a bit of Omicron, and there's some uncertainty around employment and finances, but they're looking forward thinking, it's looking okay, which is great. Now, of course, this is this data is pre-Ukraine, Russia conflict, and while that is very distant to Australia, I think it's just important to note that things like that have a huge impact on confidence levels.
Yes, absolutely.
Particularly, we saw that play out in the stock market already in terms of the Australian ASX having something like $63 billion wiped on a single day of trading when the conflict began. And that then has a flow-on effect, in terms of just consumer and business decision-making in an economy as well. So,
yeah. It also had an impact on the crypto markets, but that was just a regular Thursday.
Yeah. Brilliant. So let's quickly unpack business confidence conditions, and then we'll sort of look at a quick wrap around, okay, what is monetary policy's perspective on all of this? So what's some of the sort of main highlights, particularly for business conditions and confidence?
Yeah, so they've actually, so we touched on already on just some of the aspects of difficulty finding staff, but just to go back to that resilience, it's not just for households, but I think businesses have also really, the ones that have, unfortunately some haven't really made it through, but the ones that have, really, really resilient. So when we look at it, business confidence actually rose, 15 points in January to be back in positive territory at +3 index points after it fell very sharply when Omicron first started. I think, when we see that recovery, it's very, very encouraging.
Yeah, I think that's definitely it. Now, I think, it's still unfortunately below the long-term trend, right? But that's no surprises, I think, given, the fact that this is January data for the business investment confidence. So we don't yet have sort of Feb insights and how that's responded a little bit more. I think overall, you can see that their belief in business conditions has also turned around considerably. So I think there is, some real positive there. Unfortunately, though, there are some challenges. There are concerns around trading, profitability, and employment. So overall, there's been a bounce back, but there's, I think, always a lag effect that occurs with business confidence between the confidence and then, okay, what does that mean for actual trading, employment, profitability, which is actually rubber hitting the road in terms of service delivery. So no surprises. I think we'll see that play out. Really, I think pending, again, ongoing sort of Omicron recovery. So that's, I think, a real positive, which is key because, again, the government has invested significantly in the fiscal sort of budget in programs to encourage business investment and in confidence. And so I think it's good to see that, arguably that has remained pretty robust.
Yeah. I think just to quickly wrap that up there, but I think there's also just worth considering just what the different industries are feeling. Yeah. So definitely, as probably expected, retail was one of the biggest fallers in this business confidence index. You also had transport and construction, right? Fairly understandable why. But then in terms of the ones who did do a little bit better, mining continued to remain quite strong.
Again, no surprises as well, right?
And then you also just got some of the more service-based, professional service-based, where you can still work from home. So finance, that are still a little bit stronger.
Mm-hmm. Yeah. So now let's, as we sort of come into a bit of a wrap-up, look at a little bit of where monetary policy sits on a lot of this, because I think that's one of the big talking points. I think both if you've been reading the news and sort of the business news, around both the banks and analysts making commentary on what they expect will happen with interest rates, and then of course the impact that'll have on the housing market and confidence levels in the economy more broadly. Now, what I find interesting is just before we dive into this, we've got to remember that, really we've got, this idea, and I think the RBA even explicitly in their recent minutes, they say it, but they don't, but they acknowledge it, that the RBA almost wants the market to think they're going to do something so that the market prices it in and responds, and then the RBA hasn't had to do anything. And so that's sort of this idea of jawboning, right? Where the RBA might talk and suggest things, like suggest that interest rates are going to rise at some point, and then the market responds. And the whole point of that then is it's that self-fulfilling sort of cycle that it creates the impact of the interest rate rise, in terms of maybe softening, confidence and demand a little bit without the RBA actually having to do that. So I want to share that as a quick bit of like setup here.
Yeah.
What's monetary policy sort of at a high level? What's their observations?
Yeah, so I think it's good just that we talk about that jawboning, that they've actually been able to really make a bit of a turnaround without actually having to do very much.
Yeah.
So they basically feel that we've responded quite quickly after Delta. Took a bit of we're going to take a bit of a dip from Omicron in the March quarter, but they do have a bit of consensus that it's really not going to make as much of an economic impact than the Delta, and then do we call the other one the Alpha? Is that what, I don't know. But the original
Yeah.
COVID
COVID
strain.
number one.
Yeah, COVID number one. Yeah, so I think, Rowan, you've already touched on some of these numbers before, but we're expecting about 4.25% in 2022, slowing down to about 2% in 2023, and then reviewing 2021, they did realize that we did get about 5%. So generally pretty good recovery.
That's right. Now I think they've also noted, wage growth has picked up, but it's just back at pre-pandemic levels, so there's still work to be done there. And they did note that inflation, it's the first time underlying, which is at 2.6. Basically what they're saying, it's the first time in 7 years that underlying is at the midpoint of the target range, essentially, the 2 to 3%. And so that's great. And what they're also highlighting is, look, it's still well below other advanced economies. So while there is significant concerns coming out of the US with inflationary pressures at the moment, and as a result, suggests that we'll see some Fed activity in the US a little earlier. It really was, I think, for me, a little bit of a suggestion that the RBA is like, look, yes, the rates will shift at some point, but maybe not as early as people think. Yeah. Right?
I think I want to touch on that, just that you mentioning jawboning earlier. Like, if you think back, so some of you may have only started the course last year, so you might not have been following, but when the pandemic first started, they basically went out and did do their very first bit of jawboning, which was that the interest rates would not shift until 2024.
Yeah.
And then obviously now we're in 2022, and then we're already getting conversations about when that rate is going to go up. So I think it's very clear that if you look at them on a very literal sense, and you don't really understand jawboning, you're going to think that they're just out here lying to the Australian public. But there is a reason for it, and I think it's worth unpacking that just in your responses.
Yeah, definitely. Now, I think just quickly, remember that the RBA takes a lot of lead as well from global monetary policy decision making as well, right? So this is not made in isolation. And so they do spend some time considering what's going on more broadly. And so, they've made the highlight that, okay, the Bank of England, Bank of Canada, Reserve Bank of New Zealand, amongst others, have ceased essentially quantitative easing programs, right? In response to economic conditions. The US Fed Reserve, the European Central Bank haven't yet ceased, but they're expected to. So they've certainly taken that on board quite strongly. They've also identified that both the Fed Reserve in the US and the Bank of Canada are expecting to increase rates as early as March. Now, note they have distinguished, though, that both those countries are experiencing higher levels of inflation than Australia and have different market drivers that are influencing that, which is why I think, even though CBA and a bunch of big banks think we'll get interest rate rise as early as sort of June, whether or not that's necessarily going to be the case is not yet clear, at least from the sort of minutes that the RBA provided. Now, they did note, which I thought was sort of interesting here as well, is that they did note, which is my point around, they've observed that the sort of jawboning is working. They said that they observed that market economists had brought forward expectations of cash rate increases, with most now expecting the first increase towards the latter part of 2022. And they did highlight that they also had sort of noticed that they'd already been priced into the market as a result, which was in essence saying, well, hey, great, the market's already responding to the possibility of an earlier rate rise. Now, I think just to sort of come back, like what in the end, was their final sort of policy decision moving into, the 2020 year. And what does that maybe mean?
Well, they haven't done anything yet, right? So they've held off. But I think, what they're playing here is just that they're using their minutes to really just do the work for them rather than having the explicit cash rate target
That's right.
Change.
They did make one major change, though, in this, and I think that is that they did make a decision essentially to cease quantitative easing, right? So they made a hard date, 10th of Feb, no more QE in terms of bond purchase. Now, it does leave them, and that's one of the decisions they've identified and what they will do moving forward. It does leave them in a position where they hold 42% of outstanding Australian government securities, which is in their target range that they had set, but still significantly large as well.
Yeah, I just want to quickly just add, so that does have, I guess, some balance of payments ramifications. So normally, the percentage of securities held by overseas investors is usually quite large. So the RBA themselves having 42% of it might actually help out in terms of reducing the income flows.
Yeah, the net primary income. Yeah, definitely. Which is, I think, a really interesting sort of connection point. And I think that just goes to show that this HSC Economics course is incredibly interconnected. And so it's worth being mindful of that. As we wrap up, Terry, any final comments on the state of the Australian economy for 2022?
I'm excited.
Cool.
That's my...
Excellent. Look, I would agree. I think overall it bodes for, there's still some, there's a little bit of chop in the water still, certainly because of Omicron, but I think it does bode overall, assuming there's no new variant that emerges that's otherwise, more dangerous. I think it does bode really well for Australia in terms of, ongoing strong economic recovery. So if you have any questions, guys, about the state of the economy, anything that we've shared in this video, let us know in the comments below. We'll do our best to help out. If you're looking for more support in HSC Economics because you've started the course, you're thinking, oh crap, there's all this stuff I've got to get my head around, and you've stumbled onto this video, get in touch with us at Art of Smart Education. We've got a fantastic team of economics tutors and teachers, both small group classes and one-to-one, that we can really get in and support you, really master both the substantive content of the course, but also really start to improve that quality of the analysis that you can bring in those extended responses. Otherwise, we will see you on the next episode of HSC Economics Review.